This is the Retirement Key Podcast with Justin Doback, financial advisor of Abish Financial Services.
Welcome back to the Retirement Key. My name is Casey, and today we are digging into something that can quietly eat away at even the most carefully crafted retirement plans, and that is taxes. And here's the thing. Just because you stop working, it doesn't mean the IRS stops charging. In fact, for a lot of retirees, taxes become more complicated, not less.
Bingo.
So to help us better understand the complicated world of taxes, I'm joined by Justin Doback, a financial advisor at Abish Financial Services. Justin, hello to you. How we doing?
I'm doing really well. We've got our first little lick of summer outside our window right now, which is well welcomed. But more importantly, it's taxes and retirement. How's everything going with you?
Let's talk about it. It is going well. And before we dive in here, I just want to quickly remind our listeners to head over to theretirementkey.com. Justin and his team have great tools. And from there, you can schedule time with them and they can help you build a personalized tax strategy for your retirement years, which is something everyone needs. All right, Justin, let's just jump right in to the good stuff that we've got on the docket today. A lot of folks are surprised to learn that not all of their retirement income is tax-free. So my first question for you is, how will someone's retirement income be taxed, and what do we need to be looking at to determine what we can expect?
Yeah, absolutely. You know, throughout your working career, it's wages. It's simple. It's okay. I make dollars and I'm taxed on those dollars. But when you get to retirement and we lose that magical thing called wages, well, there still are income streams, whether that be, you know, IRA distributions, 401k distributions, pensions, disability pensions, as well as, you know, that big obvious one, Social Security. All right. And how are all these taxed? Now, a lot of the ones I just talked about are just as your wages were, fully taxable, right? Wages, IRA, traditional IRA distributions, 401k distributions, etc. The big one in conversation right now is Social Security, right? And I know there's some word on the hill right now of maybe Social Security becoming tax-free. Well, newsflash, not exactly tax-free, but what they're going to do is they're going to give you a tax credit, potentially. But at the moment, as long as married filing jointly, you're making over $40,000, I'll keep it super simple for you. Your Social Security is 85% taxable. If you're a half glass full person like myself, 15% tax-free.
There you go.
So there's
a
lot of options out there in the world.
Yes. Well, I think a lot of people go into retirement thinking that their taxes are just going to drop automatically. But if you're drawing from multiple sources or living on a strong income, that might not be the case for you at all. So can you break that down for us a little more, Justin, specifically how the different income sources in retirement are taxed, like Social Security, pensions, IRAs, Roth accounts?
So we talked about Social Security. Let's talk about the three other major, I call them the tax buckets, okay? You have the tax deferred buckets, which is any dollar retirement accounts, traditional IRAs, you have not paid taxes on, okay? What Uncle Sam wants is whenever you take dollars out of those accounts, dollar for dollar, that increases your taxable income, and it is taxed at your ordinary income rate. So if you have income of $100,000 in retirement, you take $20,000 out of your IRA, guess what? Your taxable income, $120,000. Okay, so that's the tax deferred bucket. My personal favorite, it is not the best, it's just my favorite. It adds a lot of flexibility to plans, is the long-term capital gains and short-term capital gains bucket. Okay, these are your brokerage accounts. This is what you have bought Apple stock in the 90s, and now it's worth bajillions of dollars. I know that's not a real number, but we'll act like it is. It's now worth bajillions of dollars. It's up to you to incur those taxes only when you sell. And as long as you've held that position for more than 12 months and 1 day, it is taxed at long-term capital gains rate, which there's 3 different rates. And to keep it very simple, all right, married filing jointly, as long as you made under $98,000, your capital gains rate is goose egg. 0. Anything up to, I believe, about $584,000, you're in the flat 15% capital gains rate. That rate you'll probably find is a whole lot more attractive than your your effective tax rate. Okay. Anything if you make beyond $584,000, that's when that capital gains rate goes up to 20%, as well as the net investment income tax, which Imbaba put in place back in the 2010s. It's basically if you're making any more than $250,000, that's where you have to incur an additional 3.8% on any capital gains. Now, short-term capital gains, simple enough. It's just taxed at your ordinary income rate, so not that attractive. The last bucket and the best of all, as well as my second favorite, is anything Roth after tax. The taxes have already been paid. Uncle Sam cannot get any more. Okay, so it's a really good strategy to try to bolster up those last two buckets as much as you possibly can in retirement. That's how you build an effective tax planning strategy.
We love when Uncle Sam doesn't get any more. I think there's a lot of moving parts, though, and you got to be thinking several moves ahead always. And the most important thing to remember here is incorporate the help of a professional sooner rather than later. It can make your life so much easier.
Casey said it, not me.
All right. Now, one of the big turning points for retirees is when they hit that RMD age. So, Justin, talk to us about that. How do required minimum distributions impact someone's tax strategy in their retirement?
Yeah, in your retirement, your RMD age is going to be anything from 73 to 75. If you're born after 1960, it's going to be 75 years old. And at that time, Uncle Sam is going to come knocking on the door and saying, hey, for that tax-deferred bucket we just talked about, guess what? It's time to pay. Gimme, gimme, gimme. And what he basically makes you do is take a distribution, right, required minimum distribution of around 4.2%. What you do with that distribution is entirely up to you, but you must pay the taxes on it, okay? So those dollars can go to charity, and we'll talk about that in a moment, a qualified charitable donation. It can go right back into a brokerage account, get back to working for you again. One thing it cannot do is go into a Roth IRA. And I think that's a great segment into what Roth conversions are and how they can bleed into any effective retirement plan. And basically the concept of a Roth conversion, because I know it's talked about a lot nowadays, is it is a bet on tax rates. If we think that your tax rates are going up in the future, doesn't it make sense to voluntarily pay the taxes when you're not making what you'll be making in the future? The answer is yes. But typically, Roth conversions do not make any sense once you hit that RMD age, because now your floor is set to the highest it will probably ever be and will continue to inch up from that point moving forward. So come into the front door and talk to us. If you do not have a tax planning strategy laid out and you want to talk about Roth conversions, we are the people to help lay that out for you. What makes sense, what doesn't make sense, etc. Yep.
Yeah, so with these RMDs, you could end up withdrawing more money than you actually need just because the government is telling you you have to, and then you're getting hit with a higher tax bill all in the process. So
exactly,
definitely something people need to be prepared for before they hit that RMD age. Have a plan in place, people. That is what we're telling you. Okay, let's shift gears. You touched on it a second ago, but I want to talk about estate planning and how retirees can be more tax efficient when it comes to gifting money or passing money on to heirs. Talk to us about that, Justin.
Absolutely. And for a lot of the high net worth people that we deal with, right, estate planning becomes a concern. And I'm going to throw out some scary numbers right now, and don't let it alarm anyone.
Brace yourselves.
Okay? There is this thing called the estate and gift tax lifetime limits. All right. And per person, it is $13.9 million. Okay. Now, what that basically means, I know that's a large number, is as long as your estate per person, so couples, right, we add that together, as long as your estate is below that, we don't have to worry about the estate and gift tax limit. But what that limit is any dollar beyond that $13.9 million per person, it's taxed at what I call the death tax. Flat 40%. Whew. Okay. Now that's a scary thought, especially when we start talking about millions and millions of dollars. Now there are some very effective ways to reduce estate size. Okay. Irrevocable trusts being a really great source. Life insurance policies, that's another great option. Okay. There are ways to mitigate that estate to ensure that we're not coughing up that 40% at the end of life. Now, here's the scary part. Okay. There are a lot of talks in the word and the Hill right now of potentially reducing that limit from 13.9 million per, chop it right in half. Okay, that's when we start getting into some more reasonable portfolio sizes. Okay, so we just want to make sure that folks have a plan in place, are cognizant of these rules and other ways to mitigate. I talked just a moment ago about those charitable donations, right? Let's say you have very large pensions, okay, and we're funded for the rest of our life, but we still have to take that RMD out. Well, this is an option for you. They're called qualified charitable donations. And basically what you can do, as long as you're older than 70 and a half, you can direct that RMD to a charitable organization of your choosing as long as they qualify as a 501c3b organization. Keep it simple. Just think of the big ones. Blue Cross, right? American Cross, all those massive charitable donations. Those are the ones that are going to be able to do that. Now, you can donate your RMD up to $108,000 each year and basically take a dollar for dollar write-off off your taxes. So a really great strategy for those charitably forward individuals trying to reduce taxable income as much as they possibly can later in life.
Absolutely. Definitely a great option. Now, Justin, I always love it when we can tie what we're talking about into real life. So before I let you go, can you share a success story of someone that you helped with their retirement tax strategy?
Yeah, absolutely. And this is one of my favorite strategies. It doesn't always happen for everybody, right? The stars need to align. But if individuals are, let's say they have a big chunk of money in that tax deferred account, okay? And the RMD years are just simply going to be scary. There's no avoiding it. But maybe they're okay to retire a little sooner rather than later. What we can do is pause benefits, Social Security, potentially live off brokerage accounts, right? That long-term capital gains rate. We can pay long-term capital gains at 0% up to $98,000 married filing jointly, and anything beyond that 15%. In the meantime, we've built out a Roth conversion strategy from, let's say, 62 years old to 75, all right? Trying to reduce that tax deferred bucket as much as we possibly can, paying the taxes at a dramatic discount. So at the time they get to those RMD years, Uncle Sam, guess what, buddy? We've converted a lot of it. You're not getting your taxes at that higher rate now. And this is something that we do on a daily basis. I can't even put a name or face to that given strategy because that's something we implement quite literally on a daily basis. So come and sit down and have a conversation with us. If those are some of the tools you had, and like I said, the stars align, have that conversation. Be aware of the strategies out there in the world because a lot of times they are going to be very, very beneficial for you.
Absolutely. Well, thank you so much for sharing your insight with us today, Justin. I think this all goes to show that the sooner you start building that strategy, the more options you are going to have. And like I said, incorporating the help of a professional can make all the difference for you. So if you are listening and you're ready to take that leap yourself, you can head over to theretirementkey.com. Schedule a time to sit down with Justin and the team there at Abish Financial Services and start building a plan and a strategy that works for you. Thank you so much for joining us here today, and we will catch you next time right here on The Retirement Key.
Thanks for listening to the Retirement Key Podcast. To learn more about Abish Financial Services, visit theretirementkey.com. Abish Financial Wealth Management is a registered investment advisor with the SEC. Registration as an investment advisor does not imply a certain level of skill or training, and the content of this communication has not been approved or verified by the United States Securities and Exchange Commission or by any state securities authority. The information contained in this material is intended to provide general information about Abish Financial Wealth Management and its services. It is not intended to offer investment advice. Investment advice will only be given after a client engages our services by executing the appropriate investment services agreement. Information regarding investment products and services are provided solely to read about our investment philosophy and our strategies.